Before you pack your bags, move your money overseas, or give up your U.S. passport or green card, you need to understand one thing that almost nobody talks about clearly enough: the U.S. exit tax trap. This is one of the most expensive financial mistakes Americans can make when moving abroad, and every single year people lose hundreds of thousands, sometimes millions, simply because they didn't understand the rules before they left. A lot of people think moving overseas is simple. They believe that once they leave America, the IRS loses power over them. That is completely wrong. The United States is one of the only countries in the world that taxes based on citizenship, not just residency. That means even if you live in another country for 10 years, 20 years, or the rest of your life, the IRS can still require tax filings, reporting requirements, foreign account disclosures, and potentially major taxes when you decide to officially cut ties with the United States. And this is where the exit tax becomes dangerous. The exit tax is not a small paperwork issue. It is not a minor filing requirement. In some cases, the IRS basically pretends you sold all your assets the day before you leave America permanently, even if you did not actually sell anything, even if you did not receive cash, even if the value exists only on paper. That means your stocks, your business, your retirement accounts, your investment property, your crypto, your partnership shares, your company ownership, all of it can suddenly become taxable. And here's the scary part. Many people do not realize they qualify for the exit tax until it's already too late. Today, we are going to break this down in plain English. No confusing legal jargon. No complicated tax code explanations that make your head spin. Just the facts you absolutely need to know before making a life-changing move abroad. If you are an American thinking about retiring overseas, relocating for lower taxes, moving for lifestyle reasons, or even considering renouncing citizenship one day, this information could save you a massive amount of money and stress. Now let's start with the biggest misunderstanding people have. Many Americans believe that moving abroad automatically ends their tax obligations. It does not. Simply living in another country does not free you from U.S. tax rules. You can live in Portugal, Mexico, Thailand, Dubai, Singapore, Panama, Italy, or anywhere else in the world, and the IRS may still expect annual filings. That surprises many retirees because they assume retirement abroad means financial freedom from the U.S. system. But the reality is far more complicated. The real issue begins when someone decides they want to formally separate from the U.S. tax system. That usually happens in one of two ways: either renouncing U.S. citizenship or giving up a long-term green card. And once that happens, the IRS wants one final settlement. That settlement is what people call the exit tax. Technically, it's governed under Internal Revenue Code Section 877A. But forget the legal label. Here's what matters. The government may treat you as if you sold your worldwide assets the day before expatriation. Again, that does not mean you actually sold them. The IRS simply acts as though you did. That means unrealized gains can suddenly become taxable. Let's say you bought stock decades ago for $100,000, and now it's worth $1 million. You never sold it. You never cashed out. But under the exit tax system, the IRS may treat that $900,000 gain as taxable income. Now imagine the same situation with real estate, a private business, or crypto investments that exploded in value over the years. You can see how quickly this becomes serious. Now here's the key question. Who actually gets hit with the exit tax? Not everyone. The IRS uses something called covered expatriate rules. If you become a covered expatriate, you may face the exit tax regime. There are three primary tests. First, the net worth test. If your worldwide net worth is $2 million or more on the date of expatriation, you may qualify as a covered expatriate. Notice something important here. This is worldwide net worth, not just U.S. assets. Your foreign property counts. Your retirement accounts count. Your investments count. Your ownership in businesses counts. Everything gets added together. And many retirees accidentally cross this threshold because of rising home values, retirement savings, or business appreciation over time. A couple living comfortably overseas may think they are middle class, but if their assets exceed the threshold, The exit tax rules may apply. Second, the tax liability test. If your average annual U.S. income tax liability over the previous 5 years exceeds a certain threshold adjusted annually for inflation, you may also qualify. The exact number changes each year, but for many successful professionals, investors, or business owners, it's not difficult to cross. Third, and this one catches people constantly, the compliance certification test. If you cannot certify under penalty of perjury that you fully complied with all U.S. federal tax obligations for the previous 5 years, you may automatically become a covered expatriate. Think about how dangerous that is. Maybe you forgot an FBAR filing. Maybe you missed a foreign account disclosure. Maybe you filed incorrectly while living abroad. Maybe you used a foreign investment that created complicated reporting requirements. Even small compliance mistakes can create major problems later. That's why so many expats get blindsided. They think the issue is only about wealth, but compliance matters just as much. Now let's talk about what the IRS actually taxes. Under the mark-to-market system, the government looks at most assets and calculates the unrealized gain as if sold the day before expatriation. There is an exclusion amount that adjusts for inflation annually, which helps reduce part of the taxable gain, but gains above that amount may become taxable immediately. And remember, this is not limited to cash sitting in a bank account. It includes investment portfolios, real estate, business interests, partnership ownership, foreign assets, and potentially cryptocurrency. Now retirement accounts are handled differently, and this is where people get confused. Traditional IRAs, 401ks, pensions, and deferred compensation items often have separate rules. Some accounts may face withholding requirements. Others may trigger deemed distributions or future tax obligations depending on treaty treatment and compliance status. The details become extremely technical very quickly. And this is why trying to DIY an expatriation plan using random internet advice is extremely risky. One bad assumption can create six-figure consequences. Now let's address another dangerous myth. Some people think they can avoid the exit tax by transferring assets to family members before expatriation. Be careful. Gift tax rules, valuation rules, anti-abuse provisions, and timing issues can create even bigger complications. Others think they can simply move abroad and ignore the IRS forever. That strategy may work for a tiny number of people with no U.S. assets, no future U.S. travel plans, and no concern about financial restrictions. But for most people, ignoring the system is extremely dangerous. Banks around the world now cooperate heavily with U.S. reporting requirements through FATCA. Foreign financial institutions often identify U.S. persons automatically. International reporting has changed dramatically over the last decade. The old days of disappearing quietly into another country are mostly gone. Now let's talk about the emotional side of this because nobody discusses it honestly enough. A lot of Americans retiring abroad are not trying to cheat the system. Many simply want a better quality of life, lower living costs, safer communities, better healthcare affordability, less stress, more freedom. Some want to stretch retirement savings further. Others want warmer weather or a slower pace of life. But when they begin researching the process, they suddenly discover an incredibly complicated tax system waiting for them. And that creates panic. Because now the dream retirement plan becomes tangled with legal rules, tax exposure, reporting requirements, and fear of making mistakes. That fear is justified. The penalties connected to international reporting can be severe. FBAR penalties alone can become enormous in certain situations, and once someone starts thinking about expatriation, the stakes become even higher. Now here's something extremely important. Not everyone should renounce citizenship. In fact, for many retirees abroad, keeping citizenship and remaining compliant may be financially smarter than triggering an exit event. This depends entirely on individual circumstances. Some people become obsessed with escaping taxes without calculating the total cost of expatriation itself. They focus only on future savings while ignoring immediate tax exposure. That's a mistake. A proper analysis requires comparing long-term outcomes, not just reacting emotionally. For example, someone with substantial unrealized capital gains may discover the exit tax costs more than decades of continued filing obligations. Another person with moderate assets and clean compliance history may find expatriation manageable. Every situation is different, and that's why blanket internet advice is dangerous. Now let's discuss one of the most overlooked issues: timing. Timing can completely change the outcome. The year you expatriate matters. The value of your assets matters. Your residency status matters. Market conditions matter. Currency exchange rates matter. Even business valuation timing can matter enormously. Imagine someone owns a startup expected to explode in value next year. Renouncing before the valuation spike could create a dramatically different result compared to waiting. The same applies to stock portfolios, real estate booms, or crypto cycles. Strategic planning matters. This is not something you want to handle casually after booking a one-way flight. Another major issue involves state taxes. People often focus entirely on federal tax obligations while ignoring state residency rules. Some states are aggressive about determining whether someone truly ended residency. If a state believes you still maintain sufficient connections, they may continue pursuing taxes even after departure. This becomes especially important for people leaving high-tax states. Proper departure planning matters. Documentation matters. Residency evidence matters. Your timeline matters. Now let's talk about long-term green card holders, because many people assume the exit tax affects only citizens. That is incorrect. Certain green card holders can also trigger expatriation tax consequences. Generally, if someone held a green card in at least 8 of the previous 15 tax years and then formally abandons it, exit tax rules may apply. This surprises many immigrants who spent years building lives and assets in America before deciding to leave. Again, planning becomes critical. Now let's address another issue people rarely discuss openly: inheritance consequences. Expatriation can affect family wealth transfers. There are special tax rules related to gifts and inheritances from covered expatriates to U.S. persons. This means the impact of expatriation may continue affecting family members later. So when people say, "I'll just renounce and move on," they often overlook long-term estate planning implications. And estate planning becomes especially important for retirees with children, grandchildren, trusts, or multi-country assets. Now let's discuss compliance, because this is where many people get trapped. International tax compliance is not simple. Foreign mutual funds may trigger PFIC rules. Foreign corporations may require special reporting. Foreign trusts can create complex filings. Even ordinary bank accounts may require disclosures. And retirees abroad often unknowingly create problems because local financial products in another country may receive terrible tax treatment under U.S. rules. Something perfectly normal overseas can become a compliance nightmare for Americans. This is why experienced international tax professionals matter. Not every CPA understands expatriation. Not every tax preparer understands international reporting. Not every financial advisor understands cross-border planning. And unfortunately, bad advice in this area can become incredibly expensive. Now here's another important reality. Some countries are more tax-friendly for Americans than others. Tax treaties matter. Residency systems matter. Foreign pension treatment matters. Healthcare systems matter. Banking access matters. Investment restrictions matter. And some foreign banks simply do not want American clients because of FATCA compliance burdens. That means Americans abroad sometimes struggle to open accounts, access investment platforms, or obtain normal financial services. People rarely mention this in glamorous retire overseas videos online, but it's real. Now let's discuss the psychology behind why people ignore these risks. Most people postpone dealing with complicated financial issues because the topic feels overwhelming, the paperwork seems intimidating, the rules feel confusing, and many assume they'll figure it out later. But later is often when mistakes become irreversible. The best time to plan expatriation is years before it happens, not weeks before, not after receiving foreign residency, not after moving assets incorrectly, not after accidentally triggering compliance issues. Advanced planning creates options. Lack of planning creates penalties. And here's another uncomfortable truth. The IRS has become far more sophisticated regarding international enforcement than many people realize. Global information sharing has expanded massively. Foreign banks report more data. Digital financial records create trails. Cross-border transactions are easier to track. and governments increasingly cooperate. That doesn't mean every expat is under investigation, but it does mean careless assumptions are dangerous. Now let's talk about one specific area that causes huge confusion: cryptocurrency. Many expats believe crypto offers privacy or escape from tax systems. That assumption can become extremely dangerous. Crypto gains may still fall under exit tax calculations. Reporting obligations may still apply. Exchange records can still create evidence, and regulators worldwide continue expanding oversight in this area. If someone built significant crypto wealth and later expatriates, professional planning becomes essential. Now, another issue many retirees overlook involves healthcare and retirement benefits. Expatriation decisions can affect future financial access in ways people don't initially consider. Social Security eligibility abroad depends on various factors and country agreements. Medicare generally does not provide broad overseas coverage. Private healthcare planning becomes critical. Currency risk becomes important. Inflation differences matter. Political stability matters. Banking accessibility matters. This is why retirement abroad should never be treated purely as a tax decision. Lifestyle, healthcare, legal systems, family access, language barriers, and long-term stability all matter just as much. And here's something else. Many people romanticize moving abroad because they are frustrated with life in America at a specific moment. High living costs, political division, healthcare expenses, stress, burnout, taxes. But permanent expatriation is one of the biggest legal and financial decisions a person can make. Emotional decisions combined with incomplete information can create lasting consequences. That's why slowing down and planning carefully matters. Now let's discuss the difference between living abroad and fully expatriating. These are not the same thing. You can live abroad for years while remaining a U.S. citizen. You can potentially use foreign earned income exclusions if working overseas. You can structure residency carefully. You can remain compliant while benefiting from international living. Many retirees successfully do exactly that, but formally renouncing citizenship or abandoning long-term residency creates an entirely different level of complexity. That's the moment where the exit tax conversation becomes serious. And by the time many people research it, they are already emotionally committed to leaving. That's dangerous because emotions reduce objective financial analysis. Now, another thing people misunderstand is that the exit tax is not always immediately catastrophic. Some individuals may fall below thresholds. Some may qualify for exclusions. Some assets may receive different treatment. Some planning structures may reduce exposure legally. But none of that happens automatically. Planning matters. Documentation matters. Professional guidance matters. And timing matters. Let's also discuss reporting obligations after expatriation, because some people assume all paperwork instantly disappears. Not necessarily. Final filings still matter. Forms still matter. Certification still matters. And mistakes during the expatriation process itself can create future complications. This is why rushing the process is risky. Now I want to focus on retirees specifically because retirees are increasingly targeted by aggressive marketing online. You see endless videos promising tax-free paradise overseas. Move abroad and pay zero tax. Escape the IRS forever. Retire cheaply in paradise. Most of these presentations oversimplify reality dramatically. Yes, some countries offer attractive tax treatment. Yes, living costs can be lower. Yes, many retirees genuinely enjoy life abroad. But none of that erases U.S. legal obligations automatically. And if someone is considering formal expatriation, the stakes rise substantially. Another issue involves asset liquidity. Imagine someone has substantial wealth tied up in illiquid assets: private business ownership, commercial real estate, partnership interests, land. Under exit tax calculations, taxable gains may appear without corresponding cash flow. That creates a liquidity problem. Someone may owe tax without actually selling the asset. That situation becomes extremely stressful. Again, planning ahead can help reduce these risks. Now let's talk about the emotional mistake many people make after reading online forums. They assume everyone else has already figured out loopholes. They hear stories about people escaping the system easily. But internet anecdotes are not legal strategy. What worked for someone else may not apply to your situation. Different citizenship status, different residency, different asset structure, different compliance history, different countries, different timing. This is why individualized planning matters so much. Now here's another major concern: family separation issues. Expatriation decisions affect spouses and children too. Mixed citizenship families face unique complications. Inheritance issues arise. Travel flexibility matters. Future residency rights matter. Education options matter. Healthcare access matters. People often underestimate how interconnected these decisions become over decades. Now let's discuss audits and documentation. International tax compliance requires records, account statements, valuations, foreign reporting documents, residency evidence, travel history, and once someone begins expatriation planning, maintaining organized documentation becomes extremely important. Poor record-keeping creates unnecessary risk. Now, something else many people fail to understand is that tax law changes. Thresholds change. Enforcement priorities change. Political attitudes change. International agreements change. What seems efficient today may look completely different 5 years from now. That uncertainty is another reason careful planning matters instead of impulsive action. Now let's address one uncomfortable truth. Some people are motivated primarily by fear. Fear of future taxes. Fear of economic instability. Fear of political change. Fear of government overreach. Fear can push people toward drastic decisions before fully analyzing long-term consequences. That's why objective analysis matters more than emotional reaction. Retiring abroad can absolutely work well for many people, but it works best when approached strategically, legally, and carefully, not emotionally, not impulsively, not based on social media hype. Now, another topic that deserves attention is citizenship regret. Some individuals renounce citizenship expecting immediate freedom and relief, only to later discover emotional, financial, or logistical complications they didn't anticipate. Travel complications, family issues, banking issues, business restrictions, unexpected tax consequences, loss of flexibility. Citizenship is more than a tax status. It affects identity, rights, mobility, and future options. That's why permanent decisions deserve deep consideration. Now, here's an important point many viewers need to hear. There is nothing wrong with wanting a better life abroad. There is nothing wrong with international retirement planning. There is nothing wrong with seeking financial efficiency legally. But there is a massive difference between legal planning and careless assumptions. The people who usually suffer the worst outcomes are not criminals. They are ordinary people who underestimated complexity. That's the real danger. Now let's discuss one final critical issue: professional coordination. International relocation often requires multiple experts working together. Tax attorneys, international CPAs, estate planning attorneys, immigration professionals, financial advisors familiar with cross-border issues. Because one professional working in isolation may miss something another specialist would catch. Cross-border planning is interconnected, and trying to save money by skipping expert guidance can cost vastly more later, especially for higher net worth retirees. Now, as we wrap this up, remember the core message. Do not make permanent expatriation decisions based solely on emotion, frustration, or internet marketing. The U.S. exit tax system is real. The compliance obligations are real. The penalties are real. And the financial consequences can be enormous if handled incorrectly. Before retiring abroad, understand the difference between living overseas and formally exiting the U.S. tax system. Understand the covered expatriate rules. Understand your asset exposure. Understand your reporting obligations. Understand the long-term consequences for your family, estate, investments, and future flexibility. And most importantly, plan early. The people who usually navigate this successfully are the ones who start preparing long before any official move happens. Not after, not during a panic, not after mistakes already occurred. Retiring abroad can be an incredible opportunity. For many people, it improves quality of life dramatically. But smart international living starts with understanding the rules before making irreversible decisions. Because once the exit tax trap is triggered, fixing mistakes becomes much harder and much more expensive.